I bought my first stock when I was 11. Well, I would have bought it sooner, but I didn't have the money. It took me about 5 years to save $120. 1942, when I bought my first stock, as an illustration of all the things that have happened since 1942. We've had 14 presidents, 7 Republicans, 7 Democrats. We've had World War. We had the Cuban Missile Crisis. We have all kinds of things. The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund. And I pointed out that if you'd put $10,000 in an index fund that reinvested dividends, and it would come to $51 million now. And the only thing you had to really believe in then is that America would win the war. And America works. Well, I like to be independent. I want to be able to do what I want to do every day. And money lets you do that. You should understand what you buy. Now, if you buy a farm, you look at the farm and you say, I expect to get so many bushels per acre of corn or soybeans, and you figure out how much that'll be worth, and then you figure out what the price should be. If you buy an apartment house, you look at what the rentals will be and what the taxes and expenses will be, and then you decide how much income you'll have, and you pay a fair price for that. But you don't, in stocks, people, their neighbor whispers something to them, and they run out and spend money that it took them years to earn. So you always want to look at the productive ability of the asset you're buying, whether it's a farm, apartment house, or a company, but the company is represented by a stock. And if you always get your money's worth, you'll do very well.
We would never have cash around just to have cash. I mean, we would never think that we should have a cash position of X percent. And frankly, I think these asset allocation things that tacticians in Wall Street put out, about 60% stocks and 30%, we think that's total nonsense. So we want to have all our money working in decent businesses, but sometimes we can't find them, or sometimes cash comes in unexpectedly, or sometimes we sell something, and more cash around than we would like means that we have 10 or 15 cents around, because we want money employed, but we'll never employ it, just employ it. And you will find us quite unhappy over time if cash just keeps building up. And I think one way or another we'll find ways to use it.
Investors behave in very human ways, which is they get very excited during bull markets, and they look in the rearview mirror and they say, I made money last year, I'm going to make more money this year, so this time I'll borrow, or the neighbor says, I wasn't in last year when that neighbor was dumber than I made a lot of money, so I'm going to go in this year. So they're always looking in the rearview mirror. And when they look in the rearview mirror and they see a lot of money having been made in the last few years, they plow in and they just push and push and push on prices. And when they look in the rearview mirror and they see no money having been made, they just say, this is a lousy place to be. So they don't care what's going on in the underlying business. And it's astounding, but that makes for huge opportunity, just huge opportunity.
Risk comes from the nature of certain kinds of businesses. It can be risky to be in some businesses just by the simple economics of the type of business you're in. And it comes from not knowing what you're doing. And it is, if you understand the economics of the business in which you are engaged, and you know the people with whom you're doing business, and you know the price you pay and is sensible, you don't run any real risk.
3 wonderful businesses is more than you need in this life to do very well. And the average person isn't going to run into that. I mean, if you look at how the fortunes were built in this country, they weren't built out of a portfolio of 50 companies. They were built by someone who identified with a wonderful business. Coca-Cola is a great example. A lot of fortunes have been built on that. And if you have a really wonderful business, is very well protected against the vicissitudes of the economy over time and the competition. I mean, we're talking about businesses that are resistant to effective competition, and 3 of those will be better than 100 average businesses.
The best moat you can have is your own talent. I mean, they can't take it away from you. Inflation can't take it from you. Taxes can't take it from you. So, when I talk to students, I see these students and I tell them, you're $1 million asset. I would pay you $100,000 to the MBAs for 10% of the earnings for the rest of your life. So that makes you $1 million asset. Now, if you can do something to increase that value 50%, if you can learn to communicate better verbally or in written form, and you become 50% more, that's $500,000 just by improving yourself. I mean, by far the best investment you can make is in yourself. I mean, if they just learn to communicate better, that's relatively easy. I did it myself. It's just hugely important. And if you invest in yourself, nobody can take it away from you.
You don't need tons of IQ in this business. I mean, you have to have enough IQ to get from here to downtown Omaha, but you do not have to be able to play three-dimensional chess or be in the top leagues in terms of bridge playing or something of the sort. You need a stable personality. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd. Because this is not a business where you take polls, it's a business where you think. And Ben Graham would say that you're not right or wrong because 1,000 people agree with you. And you're not right or wrong because 1,000 people disagree with you. You're right because your facts and your reasoning are right.
Cash is always a bad investment. I mean, when people said cash is king a year ago, I mean, that's crazy. I mean, cash wasn't producing anything, and it was sure to go down in value over time. We will always have enough cash around, but anytime we have surplus cash around, I'm unhappy. I mean, I would much rather have good businesses than cash, and we found a chance in the last year or thereabouts to deploy. We came in with something over 40 billion in cash, and we've got about 20 billion now, and we've had some earnings. So we put a lot of cash to work, and I like that. No, I'd much rather own a good business than have cash.
So you could have a cube, if you owned all the gold in the world, you could have a cube that would be 67 or 68 feet on a side, and you could get a ladder and you could climb up on top of it, and you could say, you know, I'm sitting on top of the world, and you know, and think you're king of the world. You could, you know, you could fondle it, you could polish it, you could do all these things with it, stare at it, but it isn't going to do anything. You know, it's all you are doing when you buy that is that you're hoping that somebody else a year from now or 5 years from now will pay you more to own something that, again, can't do anything.
Cash is not a place at that.
I think that the people who buy those index funds on average will get better results than the people that buy funds that have higher costs attached to them, because it's just a matter of math. If you have a very high percentage of funds being institutionally managed, and a great many institutions charge a lot of money for doing it and others charge a little, they're going to get very similar gross results but different net results.
It isn't a question about how many analysts are going to recommend it, or what the volume in the stock is, or what the chart looks like or anything. It's a question of how much cash it's going to give you. That's the only reason. It's true if you're buying a farm, it's true if you're buying an apartment house, any financial asset. Oil in the ground, you're laying out cash now to get more cash back later on. And the question is how much are you going to get, when are you going to get it, and how sure are you? And when I calculate intrinsic value of a business, when we buy businesses, and whether we're buying all of a business or a little piece of a business, I always think we're buying the whole business, because that's my approach to it. I look at it and say, what will come out of this business and when? Growth usually is a positive for value, but only when it means that by adding capital now, you add more cash availability later on at a rate that's considerably higher than the current rate of interest. So we calculate into any business we buy what we expect to have happen in terms of the cash that's going to come out of it, or the cash that's going to go into it. So if you tell me that you own a business that's going to grow to the sky, and isn't that wonderful, I don't know whether it's wonderful or not until I know what the economics are of that growth, how much you have to put in today and how much you will reap from putting that in today later on. Biggest mistakes I've made by far are mistakes of omission and not commission. I mean, it's the things I knew enough to do, they were within my circle of competence, and I was sucking my thumb. Omission is way bigger than commission. There's big opportunities in life have to be seized. We don't do very many things, but when we get the chance to do something that's right and big, we've got to do it. And even to do it in a small scale is just as big a mistake almost as not doing it at all. I mean, you've really got to grab them when they come, because you're not going to get 500 great opportunities.